Hey guys, I hope you're all having a great day. I wanted to get back with you on our integrated financial plan educational series and really talk to you about some of the cool things that we introduced last series, which was our 5 key points. And most of those key points centered around making sure that your structure of your business is set up for success. Now we're gonna dive a lot deeper in this one and really get the financial aspects covered on this week's financial integrated planning. The main thing we're going to talk about in this episode is the 3 things you need to look for as you're getting into your finance, which is your balance statement, your income statement, and your cash flow statement. Your balance sheet is actually showing all your inventory, the assets that you own, minus your liabilities that you have. Your income statement is simple. It's your P&L, which is your profit and loss, your gross revenue that you make in your business, minus the cost of goods sold, minus your expenses, that gives you your ending profits. And your third one is your cash flow statement, which is showing all the cash flow of the company and how it's being paid out. It's the one that's probably the hardest one to understand. Is your cash flow statement is your operating activities, your investment activities, and also your financial activities that go into your cash flow statement to make sure that everything is profitable. They're not the end of be all on every aspect of a business, but they are very, very, very important. If you remember from our last episode, that KPIs need to be both leading and lagging indicators. A lot of these ones we're talking about today are going to be our lagging indicators. So these are things that have already happened that we're gonna go back and renew our minds to make sure that we're setting ourselves for success. That way we can start tearing towards, or we can start aligning towards are leading indicators on things that we need to operate on a day-to-day business to make sure that we're generating the right revenue and we understand where that revenue is coming from. So let's kick it off here. First, let's take a look now at our balance sheet and understand how that affects the way the business works. So all you're doing is cash and equipment. We're gonna throw that into a pile and we're gonna say, what is this worth, okay? And then you're gonna take your accounts receivable. That's gonna be your next line item that you put in there because those are the future cash that's owed to you, right? And then you have your inventory. So most companies have inventory, especially if you're manufacturing or you're selling goods, they have assets tied into those things that you're selling. That's your inventory. It's same as cash. We want to add it back in there. And then we also want to look at work in progress. So we add that back into it as well. And then your current assets that you also hold, that's just your everyday assets, computers, equipments, and buildings and things like that. So the next thing we really look at is going to be our liabilities. So we have all of our assets listed out. Next is gonna be your liabilities. Liabilities are typically broken up into 2 different ways. One is gonna be your short-term liabilities. Next is your long-term liabilities. So things like short-term would be accounts payable. Accounts payable is something that you need to pay out. It's a debt, usually 30 to 90 days that you got to pay out. So that needs to go on your balance sheet to understand that, hey, am I taking on too much debt and I don't have enough free cash flow or cash flow coming in to cover that debt? And that's the key thing we're trying to get to here. Second is long-term debt. These are debts that are usually 3, 5, 10, 20 years down the road. That's going to be structured through amortization that you're going to amortize that over a certain period of time. So amortization is you choose how long to actually pay off that debt. And then the next one we really have is going to be our taxes. Taxes are a liability. We have to pay taxes, unfortunately, right? But we always have to do that. So it needs to be a liability or a line item inside of there. So if you take and look at your balance sheet and then you add the last variable into it, which is going to be your equity. These are things like retained earnings. So retained earnings are going to be earnings from the previous year, typically, that I didn't suck out of the company, because you want to run a company that has good liquidity inside of it. Remember return on invested capital? Yeah, that's where this plays in, right? So I made $1 million. I paid all my expenses. My profit was 30 or 40%. I only gave myself a distribution or an extra dividend, being the business owner, of 20% of that, or 50% of the profit, right? and I'm gonna leave the other 20% into the company. That way it can operate next year and has good cash flow. That is retained earnings because I've already paid the taxes on it and it's just staying there as basis. Basis is just a fancy way of saying this is how much equity I have inside the company. The main reason why you need to pay attention to your equity and make sure you have good basis is depending on the structure of your entity. Sometimes if you go negative basis, then you won't be able to use a deduction. So you always want to keep a positive basis inside your company. Let's keep some retained earnings in the company so it efficiently operates. And the key thing to remember is really comes down to real estate. So this is why you have different structures based upon the business that you're operating. Let's understand what an income statement is. And it's very, very important. This is the one where I think a lot of people kind of gloss over. It's just the general revenue that you've brought in through goods and services. That's all it is, okay? But the first thing that gets deducted out of that is gonna be COGS. And you're gonna hear this term a lot. COGS is cost of goods sold. If I bought something from a manufacturer or from a distributor or something like that, and I sell it back out, the cost of that thing is usually the cost of goods sold. If you're in a service company, that's less likely to be included into the overall income statement on the top end, okay? And then second is the expenses, and that's just to run the overhead of the company. You got buildings, you got utilities, you got insurance, you got just regular expenses that you're gonna run into. And then last is gonna be the operating profits inside of here. So once you understand the income statement, we can really get to how do I structure an income statement where I make sure that I'm profitable. And you will hear this term a lot in the industry, which is called the 30-40-30 rule. It's simple. It's 30% of your income, revenue that you generate from your business, should go to the salaries of the business. And business owners make this major key point, is as soon as you start a business, include your own salary inside of this figure, okay? I'm not saying all of your revenue or all of your income should be included. What I am saying is your basic salary. So if you had to replace yourself from operating your business, this is that reasonable compensation, the key word from the IRS, reasonable compensation that you have to pay yourself to do the job you want. Now, for most business owners, especially if you're looking at a S corporation, want to make sure that you have this number as low as possible so that you're not double dipping on self-employment tax, right? So this is one of the key benefits of being a business owner is that you can actually pay yourself a little bit lower salary. It's still got to be reasonable in the eyes of the IRS, okay? And it's got to be included into our 30% of our plan. It's very, very important that we do that. The other 40% of the plan is going to be expenses. And this is what everything else that comes out of your account that needs to be allocated for here. So that's utilities, that's buildings, insurance, interest is in here, kinda, but it is in here. It should be 40%, right? If you really want to be a profitable business, I would say make this 30% and make sure that you're operating your business a little bit leaner here. And then the last 30% is going to be your profit. Now, just because it's profit doesn't mean you can't utilize it effectively. And this is where you're going to get into some really cool terms that I think are very crucial for businesses to operate. My favorite one when I'm looking at finances of publicly traded companies and we're looking at companies to invest in, and it's called return on invested capital, or ROIC, right? Return on invested capital is extremely important because all it's saying is, so I'm taking some of that profit and I'm gonna reinvest it back into the company, and what type of return am I getting? So if you look at really good, successful companies, they're taking between 10%, like R&D, right? That is research and development that you're doing inside your company to expand. And what am I taking that R&D and I'm investing back into, and I'm creating a return on my invested capital. That's a good way to look at it, okay? So we covered a lot here, and I just want to review it real quickly for you. So if you're looking at your income statement, that's top line sales, gross revenue from services and things that you sell, minus your COGS, your cost of goods sold, minus your expenses, right? And then also what's your remaining profit, the 30-40-30 rule. I like to look at this as 30, pay yourself a reasonable salary included in there, plus all your employees, 30 again. That's where we're going to take out and make sure we're running a lean, efficient company as operating expenses. And then we're going to have 40 in our profit. Of that 40, typically 10% of that is going to be R&D. I think every company that's successful allocates a certain amount of their profit back into their R&D. Now, R&D can be a lot of different things. It doesn't have to be specifically research and development, but I look at my R&D for a servicing company like myself, I look at R&D as a lot into my marketing expense. So I tie that into it. And you get to choose how you tie in your R&D inside of there. That gives you over to your net profit. So we've covered the balance sheet and we've covered our income statement. And there's some cool things to talk about, which brings me to the cash flow statement, which is really, think of it as a time period statement. This is the time period that you elect to understand how you're paying things out and you're receiving stuff within a year, a quarter, a month, or a decade, right? It's typically not a decade, but it's usually on a quarterly basis or an annual basis. So the main activities of your business is your income statements and your balance sheet. The integrated relationship between them is a cash flow statement, helps you understand the income statement and how it gets pushed over into your balance sheet. That's a key part here. And so that's why a cash flow analysis that you need to run inside your business is also helpful to understand if you're making profit or not and where that profit shows up on your balance sheet. All of this conversation on how to run a company really comes down to one main key point, and the holy grail is free cash flow. Free cash flow is once you pay all your cost of goods sold, all your expenses, and then you pay all of your amortization, depreciation, taxes, interest, all of that stuff is paid. That gives you your free cash flow. Free cash flow is a very, very good thing, and it's a great KPI to make sure that you're operating very profitable. In fact, it's one of the most important KPIs, I would argue. However, it's not flawless. There is one thing that I think you need to look at. I don't like EBITDA because it has depreciation and amortization in there, and that's not a true expense, and it can be manipulated. This is where free cash flow can be manipulated. So it is a key point that you need to take a look at inside of your KPIs. But this is why I like EBIT a little bit better, is because it's not free cash flow that should be the first thing you look at. It is the most important, but it is the operating free cash flow, okay? So the operating cash flow is very, very important because all it does is it takes off that depreciation and amortization to show how is the business actually operating? Does it have enough cash flow to work on? So if you look at a lot of companies today, especially small business owners, they don't understand their operating cash flow and they don't understand their free cash flow inside their business. When you don't understand those two things, you don't know how much of a profit to give yourself and how much to pay yourself. And remember, one of the key things we look at is to always understand how to pay ourselves first. That's why we're in business. We want to grow things. We want to provide goods and services to people, and we like to be our own bosses. All of those things are core fundamentals that you have to have good operating cash flow and good free cash flow. So what do I do with it? How do I handle the operating and free cash flow to make myself wealthier today than I was yesterday? Simple. All we look at is first pay ourselves. Remember, we have to be a part of that 30% as a basic salary. But at the end of the day, there's the bottom line, which is that profit portion after we rolled back some of that into our return on invested capital, which is our R&D. We should be left with somewhere between 20 and 40%. Of that 40%, we're gonna pay ourselves a dividend or a distribution, depending on how your organization is set up. Of that dividend and distribution, we get to skip, in some cases, not always, I'm not a CPA, I'm just telling you this is a general rule, you get to skip self-employment tax, right? Because you're paying yourself a dividend. Now, that's not tax for self-employment. So some of our investment opportunities in retirement plans especially are limited. So you got to keep that in the back of your mind. But when you pay yourself a dividend or distribution, that is what you're going to look at from a monthly or quarterly basis to make up the rest of your salary. So typically, small businesses have paid the ownership between 5 and 15% in a salary. That is top line, okay? After you take cost of goods out. You're looking at how much do I pay myself? Well, if I make $1 million in gross revenue, I take out 30% in cost of goods sold is always a good number. So I'm actually living on $700,000 is what the revenue of my business was. So of that $700,000, I think it's reasonable, depending on the industry, whether it's manufacturing or service or what you're doing and how hard you're working in the business, is 10% should be my salary. That means $70,000 I should pay self-employment tax to run the company. It's always good to think like this for one key reason. If I sell my business, or better, remember the who, not the how. How do I work in the business? Should be who should be working in the business. So eventually I want to take myself out. So now I've already earmarked $70,000 as salary to replace my own human capital inside the business itself. See how this all kind of comes full circle? So now you want to take $70,000 out. So at one point in time, you can say, you know what? My dividends and distributions that I'm making are so good that I don't have to be the CEO, the chief operating officer, the COO, right? You don't have to be the head of sales. You don't have to run every department. You can start allocating different departments to somebody that's going to spend their full time in that department. That's how you grow the business on the who, not the how. So let's fast forward a little bit more. So now we got that right who person in there. We sleeved out that $70,000, okay? We took the 30-30-30 rule. We took another $70,000, put it back in the company as marketing expense. We're then a research and development. We're then hire somebody to make the company operate more efficiently, right? Or we're then to buy a new piece of equipment to be able to pump out twice as much product as what we used to do. That's all research and development, okay? We're developing a more healthy company inside of it. What's cool also about R&D is most R&D things can be applied to as a tax credit in some cases. Again, I'm not a CPA, I'm just telling you, look at R&D tax credits, because if you're gonna reinvest back into your company and you're using third-party consultants, or you're actually doing something that is outside the normal flow of your business, you might be able to get a better tax benefit by actually reinvesting back into yourself and your company. So in an ideal world, as you start growing, you operate the business less and less and less, and you become the operator of the business, not operating in the business, right? So that is the key where I think everybody needs to try to achieve, is the more you operate in your business, doing the day-to-day stuff, the less you're able to grow your business. And so you just want to find great people to help you operate so you can work on your business and look at it from a strategic standpoint of how do I grow this division? How do I change? What's the market doing? Is there an economic downturn coming? You know, how do I have enough expenses and savings? Let's back up for 1 second. What happens if you're not operating really well for a short period of time? Those key earnings, remember that basis from the previous year? That's retained earnings. That is what you have as a fallback. Second thing that you have as a fallback, which is not as good, is gonna be debt, right? So you can go out there and get operating debt. You can go out there and put debt on equipment or vehicles or a building. Those are cool things to have because that debt is the principal. A lot of people get this wrong. The principal is not deductible at all, okay? You're paying off an asset. That's not an asset that you own. Now you can depreciate that asset out, and that is a deduction, but the asset itself, when you look at paying a debt off, the principal payment is not tax deductible, but the interest is. And this is why you look at the way that you look at EBITDA and the way that you look at some of the things that before interest and taxes, right? That before part is important because if I went out there and bought a new building and it cost me $1 million and I went out and got $800,000 worth of debt and I paid $200,000 in cost in it, that interest payment that I'm making on the debt itself is deductible. So I always look at healthy businesses, and I would lean more towards, I'm not saying this is an absolute, nothing in business is absolute, so I always have to preference that. Sometimes it's really good to have a little bit of debt. Sometimes it's really good, but when is it and why? So the when is it is if you can deploy your capital to this project instead of paying off your building, because your return on invested capital is 25 or 30% return, and that debt, the interest you're paying on it is only 3, 4, 5, 6, or 7, It makes more sense now, doesn't it, to actually put the money, your free cash flow, back into the R&D or back into your business if it's making you more money than what the cost of the interest of the debt is. That's a key part that a lot of people don't consider. They just think, I don't want to have any debt in my business. And I'm going, well, that's not typically an efficient use of your capital. It's not going to help your business grow. Now, there's different seasons of a business. Some seasons of a business are, I'm not on a growth mode anymore. I'm at the very tail end of my business and I want to sell, so I lean up my business as much as possible and I get rid of all of my debt and I make it more efficient so I can sell it pretty soon. So those things can be a really good advantage of a business. Early companies that want to grow usually take on a lot more debt. So let's do our quick review. The 3 things that we need to look at from a financial standpoint to make sure that we have an healthy organization is our income statement, and then how is that income working inside of our business. Then we look at our balance sheet. Our balance sheet shows us what is actually making money. That's where some of the reinvesting of your capital is putting back into it. Our third one is really the cash flow statement. This integrates the income statement into the balance sheet to make sure everything is flowing correctly and there's manipulation or things that are not working inside your business. You can pick it up typically on the cash flow statement. So those 3 things are a key part of any business. How you use them is up to you. If you like this content, is it something new for us? This series of educated integrated financial planning is like and subscribe to our podcast. It lets us know that we're doing the right thing and we're shifting the company and this podcast in the right direction. I really do enjoy doing these educational series. We're probably not perfect at it. It's only our first couple of ones, but we're really enjoying it and I hope you get value with it. The best way you can show us value is actually just liking and sharing this video or podcast. If you do want to reach out and have a conversation with me or one of our financial planners on staff, feel free to reach out to us, give us a shout, send us some smoke signals, or book an appointment with us, whatever's easiest for you. Talk to you soon. I appreciate you joining us.